Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to John Teixeira once again. This week, we are back to discuss a topic, does it cash flow, where we are going to look at some deals and basically tell you, does it cash flow, and tell you the numbers. We're going to rank it based on a scoring we have made up and going to try out. So, and then just discuss, if it works, if you want to do it, ROI, right? So if you have any questions about this, want to give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Let's get into it. So first, I'll let you tell.
Well, we decided it'd be fun to try this new kind of segment that maybe we could try repeatedly over and over again, and or from time to time, whenever we come across these deals, it might help put some actual numbers to the things we talk about, right, all the time, right? Like so. Okay, John, Kyle, you tell me that I should do this short-term rental or I should do this long-term, but why? Give me the numbers. Show me why I should do it, right?
Or why you shouldn't.
Or why you shouldn't.
How a timeline works.
They're not all great deals. We've talked in the past about how you can do it badly and still win. Mm-hmm. So I hope that we can prove that here, that even some of them that aren't great maybe they don't cash flow as well on a monthly basis, but they still end up being great investments for you in the long term. And that's kind of how you and I think is on a long-term basis.
Yeah. So we got some, we were able to get access to some numbers on some actual deals from some actual number sheets from investors. So, the first one that I brought today, and these are all anonymous, but the first one that I brought today, we are going over a short-term rental in Grand Prairie that has been running. So first we're going to talk about the cash flow, right? Because I wanted to bring something that is in this very hard cash flow environment that we're currently in, and in this high interest rate market and everything. That's hard to get flips. It's hard to get cash flowing deals. One that's recent numbers. So it began as a short-term rental, started taking bookings 9 months ago. So the cash flow timeline we're going to look at is when we started renting, started generating revenue to now.
Okay, so let's set this up a little bit. I don't know any of these numbers.
No, you don't.
You handle most of our numbers intimately, so I don't know these numbers that you're about to present. I have no idea how well it cash flows or doesn't cash flow, or where we're doing on it. And I have a deal that I'm going to present to you that you don't know the numbers on.
Yeah.
All right.
And I'm going to make you score it. So we'll get into the rankings here in a bit. Okay, so this one is, like I said, it's in Grand Prairie, short-term rental. So it's been renting since August of 2024. This is when we started.
Not that long ago.
No, not that long ago.
Not even a full year yet.
A hard short-term rental market, interest rate market, all of this. So the revenue generation in that 9 months is $32,000. Just over $32,000, with a mortgage just under $12,000, cleanings cost about $7,000, insurance was $17,000, legal $950, utilities $3,100, repairs, maintenance, taxes, supplies, other setup things that may not occur over the next 12 months, $49.72 in those. So total expenses $29,394. So what does that tell us?
It tells us we made a little bit of money already.
So
like
we're looking
$10,000.
We're looking at strictly cash flow, right? So at least on this initial analysis, this first phase, we're looking strictly at cash flow. So that's a net positive $2,771. So $2,771. We annualize that over 12 months. That'd be $308 a month. Well, really just $300, not annualized over 12 months. That's $308 a month. If you annualize it over 12 months, technically it's a cash-on-cash return. Oh, never mind. Cut that. I need to come back to the cash-on-cash.
All right, that doesn't match the math that I had in my brain when I did quick math. I know quick math. My quick math isn't that great sometimes, but when I did some quick math, you had about a $10,000 difference between your revenue and your expenses.
No, in that 9 months, we had $32,165 in revenue, and total of those expenses I listed are $29,394.
Okay. That's about 3,000, not 10.
Yeah,
Got it.
$2,771.
Makes more sense.
Over those 9 months, that's
About
average
300.
cash flow of 308 per month, right?
All right, I'm back on track.
Initially doesn't sound like a lot, right? So now we got to talk about entry costs. How did we achieve even that level of cash flow in a high interest rate? How'd you acquire it? All of that. So without talking too deeply into the flip per se, this was a wholesale property that was purchased off market, and it was bought hard money. So you're talking interest only financing. So the high interest only financing of $100,000. Cash to acquire was $27,993. Renovation, setup, furnishings, $160. So your total out of pocket, like cash needed in this deal, was $187,000. With financed $100,000 of it. Total liability to $287,000.
Okay, between what you financed and your cash.
Yep.
Okay. All right, got it.
But this is getting it set up as a short-term rental. This is getting it completely
Right.
renovated.
Getting it ready.
Brand new house, modernized, new AC, everything.
People do not realize how much it takes to
straight
to
gutted
set these up.
to furnishing, setup, everything.
This one, if I remember
So
right,
to get a
was
turnkey,
down to the studs almost, wasn't it?
yeah, this one was down to the studs. So, but to answer our cash flow question, we don't necessarily need to dive into the flip numbers right now.
Well, no, but let's paint the picture properly. Yeah. You're right. This was a big renovation. It was a small house, but it needed a lot of everything from the foundation all the way to the roof. It needed everything. Some renovations that we do, that just needs, maybe it needs a new AC or new roof or foundation or cosmetics or some of those things. This one literally needed all of it from top to bottom.
Yeah.
I mean, the only thing that might be left in that place is literally some studs.
Even the landscaping
and some
the
siding
and trees and everything.
We put in massive amounts of crushed granite and landscaping and so forth to get it ready for the purpose, which was the short-term rental.
Yeah.
Okay. Go ahead. Continue.
So that's, we're talking about access here. So that's $187,000 in out-of-pocket cash that you would need to achieve the cash flow that we discussed. Those numbers of cash flow are based on doing the deal in this format. So if you put in,
doesn't seem like a very good deal to me.
Right. So if you put $187,000 into it, and you make an annualized, $27.71 over 9 months. You annualize that. Your annualized cash on cash return, which is what investors look at, is a 1.96.
I'm glad we're doing this on our podcast. We should sell this place.
Well, this is why when we talk about this, when we do this segment, it's important to point out all the other considerations, because what point of this process are we in? Because we've talked a lot on this podcast.
We're only 9 months in.
Well, we're not only 9 months in.
In a struggling short-term rental economy.
Where are we in the burr of that? We bought it.
Yep.
We rehabbed it. We repurposed it in this manner as a short-term rental and everything that goes into it.
Refinanced it.
We haven't. These numbers do not involve a refinance. Okay. So I'm going to get into that. So what you would do in the next phase, this is ideal. The forward-looking potential of a deal like this is you'd refinance it. So there was actually an appraisal done on this property for other reasons, $275. So it's worth $275 without all the furnishings, everything you put into it. So you can pull out 80 up to 75% of that on investment property, right? So $206,000. You already have $100,000 financed, so you'd have to pay that off. You'd be returning $106,000 of that cash to your pocket in a refi, at least with current numbers. And it will it would decrease the mortgage, because those mortgage numbers I told you of, earlier of what, $11,600 for the 9 months of mortgage. That's a 15% interest rate hard money loan.
So you're focusing on cash return, and you're getting to where this is going to be a positive and a net gain. Okay, so I get it. But the total between the value and what we have into it, we're kind of breaking even so far, right? If we take the total amount that we have put into it with both loans and cash, correct?
If you take out the short-term rental furnishings and everything,
Well,
It
let's
was-
not do that because
well, yeah.
we set it up for this purpose.
Yeah.
So we're breaking even, maybe even losing a tad bit if we don't.
If you're talking value,
Yeah.
if you were to sell this fully furnished as a short-term rental, no, it'd be worth more than the 275 they appraised
Okay.
it for. That was a low appraisal actually based because of what it was being used for. But
Okay, you were
regardless,
going somewhere with cash on cash return and
So
ROI.
this is
so go for
where
it.
the last step. You ideally refinance it. You pay off the $100,000 high interest only mortgage, and you get a $206,000 mortgage and return 106 of your cash to your pocket. So now you're out of pocket. Well, in the mortgage on that would be lesser than what we were paying at 15% interest, right? Or about the same once you add in principal and all that stuff. You're only out of pocket now once this is done is $81,000, right? So that sounds a lot better. You have a lot less actual cash into it, which based on the numbers we already presented would be a 4.5 cash on cash return, which in most scenarios wouldn't be ideal. We wouldn't call that a great deal. But even achieving a 4.5 right now is hard. And then based on what we expect over the next 12 months, which would be basically that cash flow doubling, because when you take out the upfront expenses that were in all those numbers, you'd be at 9%. So after the refi and the projected revenue, you'd be at 9% cash on cash return. That makes it a good deal. But you have to do, in a lot of cases, you have to structure this. You have to do all the steps, right?
All right, I'm gonna confess something right now. I'm swimming in numbers and percentages.
Yep.
I'm starting to drown.
Okay, well, that's why we have a really simple
There you go.
rating that we're going to do.
All right, let's do it.
So we're going to rate this cash flow based on some factors. So first factor is access. 0 to 1. What do you give this for access? You would have to
0 to 1. That's my rating. Can I go
you can
like
go 0 to 100.
0.75?
Go 0 to 100 if you want. Yeah,
0
you
to
can.
100. Okay, well then I would say access. This is very accessible to people, but not that many people know about these deals. So, and
You'd have to
that's
have
not
access to
because
the
you
wholesaler.
can't, right? It's
Hard
not
money
because you
lender.
can't, and the hard money lenders, which usually have to have a thing with. I'm going to give it, I'd say, between 0 and 100, I would give it a 30. So that would
30.
be a 0.3.
0.3, okay. So experience. What kind of experience you need to
Oh,
achieve the
God.
numbers that we presented in this deal?
You need a high level of experience to do this.
I'll give you 0 to 2 on this one.
And really, the only reason why we did this deal is because of our experience. Otherwise, we never would have done this deal, right? The numbers you just presented prove that somebody who hasn't done several deals like this and can't see into the future wouldn't do this. So
When
I
you
would
get
say,
low risk, sometimes low risk, low reward. What we aren't presenting in numbers is the background of this deal was location and consistent, a high level of confidence in those revenue numbers.
which is based on our experience.
Yeah, so it's not seasonal and all that stuff.
So I think we need a high level of experience in order to do this. Is that a 0 or a 2? I think it's as high as it can get.
So you'd go as low as you can get. I'm going to
Let's
give it
go
like a
0.2.
0.5. 0.2, okay.
I think this is an epitome of a deal you need a lot of experience for.
Capital 0 to 2. How much capital do you need?
We needed a lot, didn't we?
Yeah,
we
you
needed a
needed-
good percentage of it. I would do 0.5 on this one.
Yeah. I mean, you didn't put all cash into it, but you needed quite a bit of capital. All right, so time. How much time did this take? We're presenting over 9 months.
This one was a long renovation, longer than normal. And the setup.
Yeah, but the 9 months we're presenting it over doesn't the numbers we're talking about don't equate to that time. We're talking about 9 months. It cash flowed in 9 months. Cash flow's a yes.
Compared to other deals, I guess the only other deal that would be longer in this would be a complete new build, right? Other than that, this is a pretty long timeline from acquisition to, okay, we're generating revenue. About as long as it could be without being a new build.
Well, statistically, it cash flowed in a year after acquisition. So I'd put that at I mean,
You like
I'm gonna
it?
let you give
What's
the ranking.
what's the rating? What's the rating? What's my rating
0
scale?
to 2. So if you, I'd say like
A 0 is bad.
1 year would be the 1, like in between. So 5 years would be a 0. I'm gonna.
All right. Well, then let's give it a little bit. Let's give it a 1.
Let's give it a 1. All right. Appreciation. So has it appreciated in value?
Too short of a period of time.
I think
So I'd say
I think
no.
after the renovation and everything, based on its condition prior, yes, it is appreciated. But I'll let you be a final decider of that. So did it cash flow? That one's mathematical answer, right? Yes. Yes, it cash flowed.
Slightly.
0 to 1.
Slightly. It's not this deal. It's not fair evaluating this deal so early. We have to recognize that this is too early to be evaluating the deal the way we are.
No, everybody has different time horizons, and many investors will tell you like, what's their time horizon? If it doesn't cash flow by year 1, I sell it.
Then I don't think this cash flowed very well.
Well, this is a yes or no answer, and it
did it cash flow? Yes, it did.
Yeah. And is it passive or active?
$300
After 9 months, is it passive or active?
Oh,
I'd
this
say
one is more active than passive. This is not a long term.
Yeah, even if you have someone handle everything, even a GC handle everything, you're well advised to go there and make design decisions and things like that.
Okay, for us it was active. For somebody else who hired us, it would be more passive.
Had we been hired, it wouldn't have cash flowed.
Yep, that's right.
Because that margin.
So I'd say more toward the active than passive.
But over the next 9 months, that's not true. So yeah, it depends on what timeline you look at.
Yep.
So you can give that 0.5.
Yeah, that sounds good.
Okay. All right. So based on the numbers that you have decided in your ranking, this one gets cash flow score. The We Are TPM cash flow score, whatever you want to call it, from 0 to 10, based on access, experience, capital, time, appreciation, cash flow, and whether it's passive or active, is a big old 4.5.
Ooh,
4.5 under.
How do we feel
under
about
500?
Rating? How do we feel
I don't know,
about
it's
that?
close.
Rating?
It's close, right? Kind of like the Rangers right now. It's like they're just hovering there.
They are. We have hope for it. We have hope for the Rangers, and we have hope for this deal. We think it'll be a lot better in the end, but right now.
Yeah, I mean, what could have made this better? A big weight in this was capital, right? We would definitely have liked this deal to take less capital for more cash flow, right? The experience level, it doesn't. We're doing this based on investors. For us, these high experience ones are an advantage.
Let me ask you this. Knowing these numbers today, would you have done this deal at the very beginning? Would you say, yes, I want to do that deal?
Yes.
All right.
Because there is literally investors right now focusing on making deals that don't cash flow and how much they're going to lose per month in this market. So just because interest rates are high and prices are high, so achieving cash flow and a return of your cash, I would do it again.
And there's a bigger vision, right? It's not about just, $300 a month or the capital or whatever. I mean, it's a bigger vision. You're putting your money to work for a bigger picture. You're putting your money to work for you for the future. And this is how we chose to do it on this house for a whole bunch of strategic reasons, right?
And short-term rentals have become, if done right and done in the revenues and everything makes sense, the turnover cost, we talk about turnover cost a lot. It alleviates a lot of that because you're in it weekly. You're in it daily sometimes. Like there's usually not massive turnover cost. About one a year, you'll do deep clean. You'll do some touch-ups. You'll do some big projects and spend money on it, but it's mainly improvements rather than repairs. Not necessarily repairs. Let's see, make readies.
That's a good point.
As often. So.
And on the long-term rentals, every 3 to 7 years, you're doing a turnover that could cost you, it could cost you $1,500. It could cost you $8,000, right? Depending on what happened to it.
Well, that's the best time to do, modernize things and do upgrades. So a lot of times that's when it comes into play. So, all right. That's our first
Is it my
numbers.
turn?
More recent one. It wasn't long term. 4.5. John gives it a 4.5 on our score. Let's go.
All right. Okay. So I got a long-term rental. And I'm going to admit, we chose one. We kind of chose this out of the hat, like, hey, let's do this one. And I'm looking at it, and this might literally be the best example that we ever see of of everything. I mean, like I'm doing the numbers
No,
for
I don't
preparation
believe
for
that.
this. All right, let's go.
We're here to amaze people.
All right, this was acquired in September 2016. Okay.
Okay, so we got like 9 years.
There you go.
9 years of numbers here.
Rental income of $144,000.
Okay.
Okay. Total mortgage during that time of, let's round it to $87,000. And really low amounts of, now I don't believe this repair amount includes the initial turnover, so I added some for that. So, because we didn't have this system that I'm using back then when we did it. So, $112 for cleaning, $750 for legal, $4,800 for repairs, with total expenses of $45 plus $47. So that's $92,000. Let's call it $92,000 with the mortgage.
Is
right?
that so? What is that acquisition cost, or that's since?
No, that's since we started renting it.
Gotcha.
So I'm going to get into acquisition and everything here, but our total income, 144 minus that 92. I think I have $52,000.
Yeah, about just under $52,000.
Yep.
In cash flow.
In cash flow over 9 years' time.
Over 9 years' time. Let's see. So 52,000 over 9 years. What do we got annualized? That's 5,700 a year. How much did you put into it?
All right. Well, let's get into that. I don't remember what I put into it. Actually, I don't think I put much into it at all, really, in acquisition of this, because again, we used hard money. This is a burr, right? This is originally a burr. This might be the first burr I personally, no, it isn't. But anyways, sales price was $147,000, and I did current current values. So I didn't do all the numbers that you did.
It's okay.
But my initial costs in rehab were $10K. That's what I got.
Down payment.
There really wasn't much of a down payment on this one. Like I said, we used hard money and then we refinanced it.
Okay. So your out of pocket was $10,000.
Yeah, right about there.
Okay.
So I've got an ROI between, so now our sales price was $147, okay? It was actually $142 what we bought it for, and we gave the seller back $5,000 to help them out. And then, so $147, and our current value is $325. So if you add our appreciation plus our $52,000 in income, I think I did this right, that comes to that's not right. Here.
Oh, wait, you don't need to add those, because $52,000 was your cash flow over 9 years. So $5,700 a month, or annualized was $5,700 annualized is what you made.
Okay.
In cash flow. So yes, it cash flows. And then you're saying we have an appreciation.
We got to appreciate the appreciation, right?
Appreciate your appreciation.
I did some math here wrong, so let me redo some math here.
Appreciate
so
the mathematics.
Appreciation is $178,000 over 9 years.
Okay.
Right? So if we divide that by 9, that's almost $20,000 a year. Since you want to annualize it.
So your cash on you put $10,000 into it, all out the door. So that's a 57% cash on cash return.
That sounds good, doesn't it?
And then if you were to sell it tomorrow and you take that, what would you have?
$325 is our current value. Is that what you're asking?
No, your appreciation that we're appreciating right now.
20
you said
grand,
about $20,000 a month.
$20,000 a year.
Or a year. That would be a big old 250%, 57% cash on cash return.
Sounds like a good deal, doesn't it?
That does. Long-term rent. It pays off in the long run.
So one thing I didn't do here was one thing I kind of intended to do and I forgot to do here was that we don't have a ton of current cash flow. So this segment is called Does It Cash Flow? Mm-hmm. And so the irony here is, we've refinanced it a few times. Taxes have gone up, expenses have gone up and eaten into our current cash flow. So if you looked at this myopically today, it probably only cash flows much like yours deal, right? Like $100 to $200 maybe. But as you can see over the years, how much revenue it's generated, it's been a phenomenal deal. You want to rate it?
Yeah, let's rate it.
Go for it. You've got all the rating things. I don't.
All right, 0 to 1 access. I'd give this one like a 0.6, because I do think this was a more accessible deal. It wasn't necessarily off market. It was in the neighborhood. It was a word of mouth.
No, this was
thing.
off market.
This one was off market.
This was off market, and the only reason why I knew about it was because of
a wholesaler.
One of my agents brought it to me.
So you have access. You have access and opportunity there.
That's right.
We're gonna give that a 0.5. 0.5 because a lot of those wholesale deals can be found by. It's not hard to get on wholesale lists necessarily. Once you start asking, you'll get on them. Trust me.
Somebody would have paid this person $142,000 for it. It just happened to be me because I came across them first and they liked me.
Yeah. So experience to get this done. We got another hard money deal. You need that. You need to know what it's gonna, cash flow, and be able to project that. So I'm actually going to give this was 0 to 2. So I'm going to give it a 1. It's
all right in the middle. I think that sounds appropriate to
me.
Pretty
decent tools you used, conventional refinancing after the hard money.
All right.
It could have been a lot more difficult. Like,
what do we got? Let's do this as we go.
Capital.
What's our, where are we at right now?
I'm doing it.
Oh, okay.
Capital. So 0 to 2 capital. I think, 2 being the best, I'm going to give you a 2.
Oh, you know what I didn't give you?
Or like 1 point. You're getting like a 1.9 because it could. I have seen deals, and we will bring some deals that did not cost a dime. But 10 grand, 10 grand's, it's still a 5-digit number, it's still a little bit. So let's give it a 1.75. Time period here is 9 years. It didn't take 9 years to cash flow, and you didn't necessarily present it that way, but we're gonna give this how long do you think that one took to cash flow and renovate and everything?
Oh, not long at all. I had this thing up and running probably it's 9 years ago, so I'm gonna say definitely within 60 days. It was probably much sooner than that.
We're gonna get a 1.
And the other thing about this one is...
Do you agree with the 1, 0 to 2?
Sure.
A mid-grade score there. All right. So did it appreciate? We can only do a 0 or 1, but I'm going to give that a yes. It appreciated.
It definitely did.
It appreciated by over 100%, if my math is correct. Cash flow, yes, it cash flowed, right? Over your time period. So if we were to present the last 9 months on the cash flow time horizon, you're saying maybe it was a break even? I'm not going to use that to score. Just
to compare it to your other one?
Yeah, to compare it to the other one.
I would say the numbers wouldn't look as good if it was just the last 9 months because of the refinance and but then again you're gonna also take into account the capital that was pulled out during the refinance, right?
Mm-hmm.
That's cash that was probably used on another investment. So I don't know how you're going to figure that into this deal because this deal created that cash, right?
Well, it technically would just, like in the other one, it'd return your cash on cash, and then that would be negative. So you'd have some nice numbers. We like negative. Just kidding. All right, last factor is passive or active. So I'm going to give this a full 1 for passive just because, it doesn't get more passive than you're going to have to go to the table and sign documents and all this stuff to be an investor, right? So past all of that, you had 10 grand in repairs that were probably done passively.
It was an extremely easy rehab. It was basically like floors and counters, and that's it. And then I've had 2 tenants in there. My current tenant has been there for like 7 years. And they'll probably be there for another 7 years.
I love it. So I'm going to give that a passive. All right. So based on our scoring of access, experience, capital, time, appreciation, cash flow, and passive or active, this one gets a 7.25.
7.25. That feels good. That feels good.
Well, it feels like that. You said that
after 4.5, it feels
after
good.
After 4.5, it feels a lot better. I do hope this isn't that you're not right, and this isn't the best deal. We want to present.
Try to find a better one.
So
I like it.
Let's do it. So, this was fun. I think this was informative for our investors out there, our people who wanted to see and hear real numbers. We hope to be able to bring you guys some of these so that you can get the confidence to do it, confidence not to do it, whatever it may be, because the numbers will burn you or they will make you succeed. So knowing them is extremely important.
It is important, and this was fun, and I hope that this was fun for everybody else, and we continue to do this. I just realized I didn't even describe this deal at all. Nobody even knows what this is. It could be
it's a long-term rental in Mansfield,
home, right?
Long-term suburban 3-bedroom, 2-bath
subdivision home in a subdivision in Mansfield, Texas.
This is a 3-bedroom, 2-bath starter home in Mansfield, Texas. Yeah.
Yep. So. It's about what?
About as basic as you're getting around
square
here.
feet. 1,600 square feet is what it is.
Yeah. So, well, if you guys have any questions, like anything we talked about today, want to help us with this scoring rankings,
we might need help.
That if you thought it was good, you thought it was bad, let us know. Give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com, and we are out.